Today we're going to talk about why single-family, multifamily, and lots of other real estate investors are turning to self-storage to maximize their income and increase their wealth. Hi, I'm Paul Moore with Wellings Capital. We're a commercial real estate investment fund, and my fund loves self-storage. So the question is, why is self-storage such a great investment opportunity? First of all, it performs great during good economic times, and it performed well during the downturn as well. So think about it. During great economic times like now, people are buying lots of stuff from Amazon, Walmart, other places, and they need a place to store that stuff. And a lot of boomers' parents are aging and downsizing or passing away. They don't want to get rid of all that stuff, so they need a place to store it. But think about it during downturns, times like we saw about 10 years ago. People were downsizing from their 4,000 square foot home down to a 2,000 square foot home, and from a 2,000 square foot home to an apartment. For a relatively small amount of money, they could store their stuff rather than getting rid of it. So self-storage performs well in all kinds of economic times. Secondly, sticky tenants. Now, I'm not talking about tenants with Velcro on them. I'm talking about people who are willing to stay and put up with rent increases perhaps more than other asset classes. So if I had an apartment and I was renting it to you for $1,000 a month and I increased your rent by 6%, you may choose to move out rather than pay that $60 extra a month for the next year or two or three. But if you're a self-storage tenant and I raised your $100 rent by 6%, you're probably not going to take a Saturday, rent a storage truck, get your friends together, go out in the hot sun, and move all your stuff down the street just to save $6 a month. So the tenants are sticky. Now, another thing I like about self-storage is, if you haven't noticed, it's a huge industry. There are 53,000 self-storage facilities in the US. This is about the same as Starbucks, McDonald's, and Subway restaurants combined. But about 40,000 are owned by independent operators, and this includes a lot of mom and pop operators that don't operate their asset actively. They operate it more like a passive piece of real estate. They used to have the attitude, if we build it, they'll come. And that used to work, but it doesn't work anymore. And so the opportunity in self-storage is to buy an asset from a mom and pop operator, dramatically upgrade it to an institutional level standard, increase the income, increase the value, and then refinance or sell it to an institutional seller. Now, a passive mom and pop just rents whatever they have, and if they're out, they're out. An active operator raises the rent on the most highly demanded units and actually increases the number of those units, and by shifting around the unit sizes. A mom and pop would never do this. They rent what they have. An active operator is also going to use technology like social media, paid advertising, and lo and behold, some of the mom and pops don't even have a website. They add a website and increase the marketing ability and also increase their ability to raise rents on tenants, because by understanding the demographics, the motivations, the income levels of tenants, they can raise the rents on each unit individually depending on what they know from the relationships they have and the tenant demographics. Now, a passive manager will just sit there and hope people walk in the door. An active manager will be out in the community. They'll be marketing to storage companies. They'll be marketing to realtors, and they'll be out there doing marketing, and they'll be increasing the value, they'll be increasing income and the value of the facility as well. One thing I love about self-storage is there's a lot of simple, very inexpensive value adds. For example, adding truck rental, U-Haul or Penske, that can add $1,000, $2,000, or even $3,000 to the income of a self-storage facility. And we're going to see in a minute, this could be very, very powerful to your wealth creation strategy. There's all kinds of other value adds just by simply changing policies and procedures. Things like adding late fees and admin fees, raising the rent, putting in a showroom and adding locks, boxes, tape, scissors, all kinds of ancillary income opportunities. So it's said in real estate that you make money when you buy. With commercial real estate and self-storage in particular, you make money when you buy, when you operate, and when you sell. The self-storage value formula is basically buying from a mom and pop, upgrading to an institutional standard, and then refinancing or selling to a REIT. Okay, now, if you are a residential real estate owner or investor, you probably know that the value of your real estate is limited by the comparables, the comps in your neighborhood. Not so with commercial real estate. The value formula is value equals net operating income divided by the cap rate. So the value is the income divided by the rate of return in the market. The cap rate is basically the prevailing rate of return that investors expect for that type of asset in your market at that time. It might be 5 to 8%, for example. So if you can increase the numerator, the net operating income, and compress the denominator by selling to, let's say, an institutional, you can dramatically increase the value of your assets. Let's see how this could play out in real life. So if you had a self-storage facility and you had a parking lot where maybe the former owner was parking RVs and boats, you might be able to add a climate-controlled building right there. That's going to add to your cost and your income, okay? Now let's say you also could raise rates. It's very typical to be able to go into a mom and pop facility and raise the rates by 15, 20, 25%. Let's say you also set up a showroom and you started selling boxes and other items, and you added U-Haul or Penske, and you added a couple thousand a month in rentals. So you add to your numerator your net operating income by, let's say, 50%. That's not at all hard to believe. Now, let's talk about the denominator. The denominator is the cap rate. Now, if you're buying from a mom and pop, you might be able to buy at a 7% cap rate or rate of return on the money that you invest, okay? Now, if you sell to an institutional, especially if you can bundle up several of these assets and sell them all to one REIT or other institutional, you might be able to compress your cap rate from, let's say, 7 to 6%. So you've increased the numerator by 50%, you've compressed the denominator from 7% to 6%. What impact does that have on the value of the facility? That's about a 75% increase in your asset value. Not bad appreciation, but it's much better than that because you probably use leverage. Let's say you took a 60% loan to value debt on this facility, okay? That means you can multiply your asset appreciation by 2.5x to get the appreciation on equity. 75% times 2.5 is 187% increase in the value of the equity. You can't do that all in 1 year, so let's say it takes 3 years. 187% divided by 3 is over 62% ROI per year. That's just from appreciation. That doesn't count principal paydown and the income you make every year, which might be 5, 6, 7, 10% per year. You see why I love self-storage? I hope you enjoyed Self-Storage Investing 101. For more information, go to BiggerPockets.com, your complete resource for real estate investing success. We offer free content, tools, and a community of over 1 million members. Our goal is to help you be successful in real estate. We'll provide partners, deals, financing, and whether you want to create some passive income on the side or quit your job and go into real estate investing full-time, BiggerPockets is the source to give you everything you need for real estate investing success. I'm Paul Moore with BiggerPockets.com. Happy investing.